Welcome back to one more insight update on the Nio Stock. If you are new to our channel, you might want to subscribe to our channel and hit the bell notification icon. We keep posting insight updates like these on the Nio Stock very often. Chinese EV makers have had an incredible run this year. Nio's share has gained over 2,000% since January, when its shares traded at below $4. With a market cap now over $65 billion, Nio, though still a loss-making company, is close to $10 billion more in valuation than the US auto industry stalwart General Motors. But it's likely that investors are just putting their bets on Chinese EV automakers in general this year, rather than backing Nio specifically. The Chinese government has set a target for EV sales to account for half the market in 2035, and China's domestic EV manufacturers are all striving to lead the pack. Nio's soaring stock, however, marks a significant change in investor interest for the 6-year-old automaker. Since going public in the month of September in 2018, Nio had mostly traded below its IPO price, and in 2019, it had to receive a $1 billion government bailout. Nio has made some changes to its business model since then, and that seemed to have contributed to improved sales, but the company's runaway stock gains this year are more indicative of a broader trend, with US investors casting a broader net to catch the next leader in electric vehicles, in other words the next Tesla. In the first half of the year, Tesla had already emerged as China's #1 EV seller, which signaled a turning point in the Chinese market. Prior to Tesla's arrival, only industrial or fleet buyers, such as public transport and taxi firms, were responsible for most of China's EV sales. Tesla's rise indicated an advancing market for consumer electric cars in China. Recent changes to the subsidy scheme offered by the Chinese government should further benefit Nio. In April this year, Beijing decided to extend its subsidy program until 2022 for cheaper passenger cars, and said it would provide subsidy support for EV firms that manufacture cars with swappable batteries, regardless of price. That policy gives companies such as Nio, which by the way is pioneering battery swapping services, greater degree of flexibility on how it prices its models. The subsidy extension comes as Beijing sets a target for new energy vehicles, meaning electric, plug-in hybrids, and hydrogen-powered cars to account for 20% of China's auto sales by 2025. By the year 2035, all new car sales in China have to be eco-friendly, Beijing has decreed, with 50% being new energy vehicles and the remaining half filled by regular hybrids. In more latest update, Nio Stock, just like all other Chinese EV and other growth stocks this year, is going through a small correction and consolidation phase right now. This, however, we believe is temporary and only a part of the broader market move these days to move some funds away from the high growth stocks of 2020 into beaten down cyclical stocks in anticipation of the broader economic recovery in 2021. In what should be a massive cheer to all Nio investors, Nio has just reported that it delivered 5,291 vehicles in November 2020, up from 5,055 vehicles in October and more than double what it sold last November 2019. The deliveries consisted of 1,387 ES8s, which is Nio's 6-seater and 7-seater smart electric SUV, 2,386 ES6s, which is Nio's 5-seater smart electric SUV, and 1,518 EC6s, which is Nio's 5-seater premium electric coupe SUV. Nio reported, year-over-year, deliveries have risen more than 109%. Nio also said that it's in the process of accelerating production capacity to accommodate increasing order growth. Goldman Sachs has now raised its target for Nio to $59 a share. As always, thank you for watching the update. Until next time, have a profitable day.